Hey guys, Kevin Bopp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is co-founder and chief acquisitions officer of Amerinote Xchange, Abby Shemesh. Now, Amerinote Xchange specializes in loan acquisitions and secondary market funding. They specialize in all loan performance classes such as performing, non-performing, sub-performing, and reperforming, and all collateral classes, including residential, commercial, multifamily, agricultural, new construction, vacant land, and special use. And so, guys, with that, it's an honor to welcome Abby to the show. Abby, how you doing today?
Very good, Kevin. Thanks for having me on the show. I greatly appreciate the opportunity.
Excited to have you here. Excited to learn more about your business. And so, again, just give you a brief introduction there, Abby. I know there's a lot more to the story than that. And so maybe let's start there. Pass it back to you and fill in some of the blanks. You'll give us a little bit more of a background of yourself. I know you come from the mortgage origination industry. And so maybe, what did you do in your past life that ultimately brought you to where you are today with Amerinote Exchange?
Yes, absolutely. That's very germane to the conversation and the journey, I guess. As you mentioned, I started in the origination space back like four lifetimes ago in the late '90s, early 2000s. I was part of that big wave coming in as a junior loan officer after Glass-Steagall was repealed. It kind of opened up the floodgates for the mortgage-backed securities industry and the US's push to get more into the global market game, which led to the expansion of mortgage products, of course, the subprime boom. We specialized in both, in my initial entrance into the industry, I was, the traditional I worked for a traditional mortgage lender, residential, mostly owner occupied, pretty standard loan products, conforming and some non-conforming. And today it would be called non-qualified mortgages. Back then it was called either non-conforming or subprime. And that's where I began my journey, which expanded into moving through the career. My first outfit was with a small firm in Pennsylvania. We expanded to a much larger firm in New Jersey, which expanded our jurisdictional footprint across 16 different states. It also opened us up to commercial and residential mortgage lending. And that's really where I was introduced to the secondary mortgage market through one of our account executives that had visited our office one day. Some of your listeners may be familiar with the name Bear Stearns, which was acquired eventually by JP Morgan in the banking crash for pennies on the dollar after the subprime boom, and then of course crash of the Great Recession. Our Bear Stearns account exec came in and said, "Hey, I'm going over to acquisitions. This is your new account manager." I said my hellos, and of course on his way out I said, "What's acquisitions? What's this all about?" And of course he took the time to explain that once loans are created, they are then traded on what is called the secondary mortgage market. And that's where I learned about, the primary mortgage market, which was the market of originations and lending of real estate. Of course, the secondary mortgage market was the acquisition and trading of existing mortgage loans between investors and entities after the creation.
Mm-hmm. No, fantastic and very intriguing. So that opened your eyes to this whole new world. And so, talk to me about the transitional steps that ultimately led you to found Amerinote Exchange.
Yes, absolutely. So we were very, I was very intrigued with how little saturation there was. Okay, so let me take a couple of steps back. The year is 2003, and it is just booming, right? So you had a lot of mortgage activity, a lot of origination activity. We worked for companies back then where you would just answer the phone and the company paid for the lead generation, which is not really, could be hit or miss nowadays. I'm not 100% sure, but that was very easy for us, right? So you got the job, we picked up the phone, we took the loan app, the 1003, whatever it was, we got the deal done. I started wanting to expand outward because we had other loan products, and we were being told, "Hey, really, you should look into these other loan products." So I started creating my own marketing apparatus for my own book of business for this particular company into commercial, mixed use, retail. So in doing that, I noticed how little saturation there was in those areas. And then once I started kind of putting two and two together with the acquisition space, there was like extremely low saturation. So I'm going, here I am competing, race to the bottom with, mortgage rates, and race to the bottom with points, competing with other firms. And we had unique products for sure. And I wasn't losing a ton of deals, but I wanted to get a bigger market share. And I was also looking to start my own shop. So I really started doing the research in my origination space, where I was looking at the marketing, looking at the players, looking at the capital, looking at the marketing strategy, because that's really what, and I'll kind of go into greater detail down the road, but that's where our company shines, is our ability to get ourselves in front of people that other folks in our industry may not be touching, right? May not be able to tap because of our marketing apparatus, which is very unique to the industry. So in doing so, and that really carried over, and I can go into further detail, but started building that out when it really started dawning on me that this is a very low saturated environment, and it's very much so could use some, a competition. And it was very easy at that time for us to stick out head and shoulders above the crowd with our marketing apparatus. And we entered into the market pretty effortlessly. I would say the key word was effortless, until right around 2008, mid 2008, and of course we had some turbulence, but we had some really good lift. We founded the company in late 2005, early 2006, started getting some really good lift, and I'll go into the different sections of the secondary mortgage market, but we were operating primarily in the owner finance or seller finance space. We were dabbling in institutional, but that would come later. And in doing so, we really started getting lift there, really started making some headway. And of course, we ran into the capital crunch of 2008. And we didn't have as much cash on the sidelines as we should have, because quite frankly, in our lifetime, we haven't seen anything like that. We were expecting that cheap, free money, so to speak, to keep pouring in. And we got a rude awakening. We did thrive through that market because we did plan accordingly. We were very, we didn't have any debt. We had a ton of business still coming our way, and we had really good private investor relations, which saw us through the dark times, we'll say, of the late 2000s and early 2010s, when there was no institutional capital. We were really hopscotching all over the place with private capital. We did very well that way.
Okay. No, fantastic. There's a lot to unpack there. And so I want to set a very clear foundation for the listener base and for myself, just to get a better understanding and more context around maybe what the company looked like back during its first couple of years, and then how it's evolved over time. And so you guys said you got your start really with residential owner finance notes. Provide more context, if you would. I mean, is this piecemeal, one by one, buying one note at a time? Who's the individual that you're actually buying that note from? And then ultimately, what do you do with it after that?
In the beginning of the creation of Amerinote Xchange, there was very little capital to be had in that space. I mean, what we really did is we had some institutional capital with some local banks and some leverage products, but we really heavily relied on syndication or joint venture with private individuals. So we really reached out to a network and created our own network of just self-directed IRA investors who had some lazy capital sitting in, some IRA somewhere. And some of them were, seven figures, others were not. So we were really using a combination of different buying strategies going forward. So at first, it was, in the early 2000s, mid 2000s, it was just wholesaling, or some would say brokering, right? So we were just placing assets with capital. And as we, and we would do that for a fee. In doing that, we generated our own capital to play with. But in addition to that, we really started expanding outward when we started partnering with private investors and using institutional leverage. That institutional leverage went away in the late 2000s, and we really had the primary focus of our investment appetite at that point was residential owner-occupied and non-owner-occupied products. We did dabble in commercial at the time, but we didn't really stray too far out of that because a lot of the investors were not necessarily looking for, I should say, the capital partners we worked with were not necessarily interested in off the beaten path real estate products. They were looking for, it eventually evolved from performing loans, vanilla loans, just somewhere to place your money, park your money and earn a good yield, to very opportunistic purchases on non-performing, sub-performing workouts with bigger yields, greater risk. So it really started wildly morphing the investment appetite, and we maintained our balance through all of the ups and downs of that period of time, using the capital sources that we had through syndication, through participation, through leverage, and through balance sheet transactions.
Mm-hmm. No, I appreciate that. And just, I spent some time looking on the website. You had some recent case studies, acquisitions, a lot of them. I think there was a couple residential loans, commercial loans, maybe even a business loan on there. And you made a comment that you started with, performing residential notes. That was kind of the first foray. And I just getting some additional context and better understanding of the business, and more so how it's evolved over the years, was the primary business model just literally buying one-off seller financed residential notes? Is that how it all started?
How it all started, yeah. So we would advertise to private Mr. and Mrs. Smith loan holders, note holders.
So you go to public records in different counties within different states, and basically find those notes that are you can typically tell what are seller held notes, are not one of the main primary national lending companies or banks that you probably see 95% of the time. And then send direct mail, call them, and what did this process look like?
I love it. I think great question. So yes, it started in the county courthouses. It started, we at first we started buying lists. That was a disaster, right? Because we found out, the lists were sold 250 million times to, so many other people, and they weren't receptive. So we learned very quickly that we needed to build our own lists. And back then we enlisted the help of interns and other participants that would, gather information. And the way we target it was very simple. We would target, you didn't know if you were getting a first position lien or a second position lien, or like a senior or a junior. You just knew you were getting a loan secured by real estate. So what you would target first and foremost is the beneficiary or the lender on that deed of trust or mortgage instrument, because you're not going to see the actual promissory note. You may see that in certain states like New Mexico, land contracts recorded in Michigan, and you would also see notes recorded in the state of Louisiana. But for most part, everywhere else, you wouldn't see any kind of recording. So the only instrument that was recorded was the security instrument, which is a deed of trust or a mortgage. So what you would look for is Mr. or Mrs. Smith, like an individual human being name, you know what I mean? Like someone with a social security number, or you would look for a corporation. So an individual or a corporation. In some cases, you could also target family trusts, and then you can target, for benefit of FBO, which is an IRA that holds it. You're not really going to get anywhere with a trustee or a custodian for someone's IRA, but you would certainly get somewhere with an individual or a corporation. And a lot of the corporations we were seeing were like bail bonds companies. They take a lot of seconds back, or you would see construction companies, development companies, all kinds of folks taking promissory notes back, mechanics liens, solar panel installation, which was one that we kind of still dabble in. As long as it's a lien on real estate, we can purchase a $25,000 unpaid principal balance or higher. And then we would also target 36 months or older. So, right, you don't want to you can go 6 months in, right? But the more aged, the more seasoned a mortgage note, the more attractive it becomes, because now predictability is the name of the game. How predictable is that mortgage payment? And now if you're targeting you're clipping coupons, as we say in our industry, which means if you're just looking for an interest rate, you're looking to buy at a discount or buy a note and just park your money into an 8% yielding instrument. That's a very easy way for you to target. You want to make sure those payments are coming in on time. You don't want sporadic payments where you have to take the property back. That's a specific type of investment strategy. So if you're looking for that, as we call mailbox money, you want that money, that monthly payment to come in like clockwork every month. You would target aged mortgage notes, seasoned mortgage notes. You want to make sure predictability is there. There's only two ways to determine predictability. One is through how many payments have been made and how often and on time those payments are. And two, which is credit score sensitivity of the borrower, which you have no access to, at least at that point in the deal journey, right? The discovery process. So that is the two main functions: the name of the lender, how old the loan is, and is it a mortgage or a deed of trust? With that, you can then begin further targeting the assets. Now, that's just one way. I want to also add, what we did, that's one way to go about it. And that's what everyone was doing at that time, right? It was courthouse leads. What people weren't doing at that time, because Google was very new, internet marketing was very new. As I mentioned earlier in our conversation, I carried over marketing strategies that we used, which was multifold, right? So it would be professional services outreach, real estate attorneys, accountants, financial planners. We would reach out to them, title companies, loan servicing companies, to add our marketing material. If they send out a loan servicing balance sheet in an envelope to their clients, we would ask to put a business card or some sort of marketing material. Hey, you want to sell your note? Call us, because we know that they're servicing private mortgages for lenders. So that's one way. The other way,
that's actually brilliant. I like that. I mean, there's a chance you might be taking their business away from them, but if you just allow them to be the loan servicer,
exactly. As long as you get a loan servicer that's willing to do that. Some other loan servicing companies actually have mortgage trading platforms already, like FC used to have it, and Madison used to have it, but again, we're talking 2006, so it was a little bit, the market has matured since. But where we were really knocking it out of the park, where no one was touching us, was internet marketing, organic Google search engine optimization, website optimization, and pay-per-click advertising, which was really brand new at that time. And back then, just to kind of give away some secrets that are no longer accurate, but we would utilize the feature of Google. Like if you typed in sell mortgage note, you would get charged a certain dollar amount, 5, 10, 30 cents a click back then, right? But if you typed in sell mortgage not, or sell with one L mortgage note, and you start utilizing the misspellings, now you can reduce your cost per click from 30 cents to 1 penny. So we really hammered that out for a good 2 or 3 years before Google caught on to that. And it wasn't just, we weren't doing anything new. We were just copying what other industries were doing, because the way I got into it is I was really studying affiliate marketing, not necessarily using it, but like how to get 6-pack abs, how to, do all that. And you would utilize that tactic and apply it to this side of the industry. So that's what I was doing in the mortgage note space. And it matured a tremendous amount between the early 2000s and the late 2000s, because Google really came on the scene in 2004. You had Yahoo back then, but Google came into its own in the late 2000s, early 2010s. That's when we really started picking up steam. As that happened, there was more saturation with other competitors, and I can kind of get into that. But those are just some of the ways that we entered the market with, little down, not a lot of financial skin in the game, just a lot of sweat equity.
Yeah, no, I love every bit. I love the out of the box thinking and just, ninja tactics that you guys took. I love it. Just talking about, again, the business and the evolution of it, are there a lot of similarities today other than just scale? Like, you guys have grown, but is the majority of your business still purchasing, one-off notes, or, are there occasions, or is more of the business built around buying, entire portfolios of notes, or, tapes of notes?
Fantastic question. The answer is the latter. It's got to be a mix now, right? Because as we learned through our journey and our career discovery, I guess you would say, or journey into the secondary market, if you just stayed with seller finance mortgage notes, you would come to find, and especially if you're advertising through digital means. Now, if you have a robust advertising strategy where you're doing mailers, you're doing digital, you're doing, however many different forms of media that you're touching and reaching out to clients, you may have a little bit more robust result. We were heavy in digital marketing with some emphasis on offline, right? But what we noticed, whether we were doing offline or online, that the biggest thing is these would be in cycles. We would see tremendous cycles of like waxing and waning, right? Like high tide and low tide. So there would be, and the high tide and low tide really revolved around quantitative easing and quantitative tightening, right? So that pumping and that printing of dollars and the expansion, the M2 money supply really affected our industry, maybe not directly, but very indirectly. So what I mean by that is you'll see the things that I notice in our industry that really affect the cycles are like elections, especially presidential elections. Things get really slow, especially in recent years, right? But throughout every election, everyone would get nice and quiet and see what's going on. There wouldn't be a ton of activity. And then leading up to an election or directly after an inauguration, the floodgates would open. But we noticed very quickly we had to diversify. And of course, in the 2010s, when all of the non-performing loans, otherwise referred to as NPLs, started hitting the market, we started taking on a bunch of that stuff, and we were successful with some of it, but not as much as we should have been because we didn't have that much experience in that space. And we had a lot of learning curve in that period of time, but I would say our portfolio was 100% seller finance up until about 2010. And then it went down to about 80% was seller finance, 20% was institutional. And then that waned again from going up. The institutional really slowed down because the money printing started, and Fannie and Freddie were paying 105 cents on the dollar for loans. So, for 3% coupons, we don't get our money subsidized from the government. So we have to compete, when we walk, gravity holds us to the ground. That doesn't necessarily happen if you're working for a sovereign wealth fund or an insurance company or a pension fund or, anyone who's closer to the printing press. So we switched our strategy. We didn't see as much institutional. We saw some. The institutional that we did see, this is how we got into special use, was stadium notes, dormitory notes on campuses of state universities, gas stations, off the beat, churches, places of worship, Greek buildings, sorority houses, fraternity houses, off the beaten path, right? So anyone who is looking for a a single family owner occupied or non-owner occupied residence, we saw some. If you wanted to pay 97, 98, 99 cents on the dollar, which sometimes we did, we did have the ability to compete at that level. It wasn't great for us, but we definitely competed. And the majority of our institutional plays in the mid 2000s were special use. So we did a ton of off the beaten path. And now, with COVID, April, I think I'm on record on some of these YouTube channels, literally March 19th, March 20th, going on record talking about the next, everyone thought that the next wave was there. I knew that once they started stimulating the economy through money printing, on risk assets and real estate were just going to moonshot. They were going to go to the moon. Real estate, Bitcoin, the S&P 500, everyone was flush with cash. Of course, it's going to increase. What was going to be something to keep an eye on is the commercial real estate market, because of course you had the empty spaces like San Francisco. What is it, like 35% of downtown where our headquarters is empty right now. I mean, it's actually insane. So we're seeing that kind of trickle into the market now. But as of right now, today, I would say 40% institutional, 60% seller financed. So, and we feel that balance, it's just scales. It's always going to shift depending on the economic landscape. We put a wide net out, and whatever that wide net pulls back is usually denotes what the economic landscape looks like, unless we're sniper targeting institutions.
Okay. So then what does the coming landscape look like? Obviously, we're starting to see a little bit of shuttering in the commercial real estate space. More specifically related to office, some retail, some still hospitality sector. Maybe hasn't made a full recovery since COVID, since the impact of COVID. But just what are your sights set on from a company standpoint as to where there might be opportunity in the coming 12, 18, 24 months?
Good question. And, it's going to depend. So you have one large industry, right? The secondary loan market or the secondary mortgage market. There's different sections of that industry, which again, we talked about: owner carry, institutional. And then within an institutional, you have special use, you have, different types of properties, and then the lenders that hold those types of assets and what kind of investments they made. So we really get granular, right, in the marketing discovery process. So let me start with seller financing, right? The owner carry stuff. We are going to see and have been seeing a tremendous amount of short-term bridge loan, fix and flip types of assets hit the market, because a lot of the capital that was being used to offload those warehouses that were pumping out or conveyor belting those types of loans, they don't have a place to go anymore. Like companies like Torak, companies like Churchill, companies like Pier Street. These were all companies that would pay par or 100 cents on the dollar for these short-term loans. There's been a lot of disruption there. And I will also say, just take a couple steps back, in the non-qualified mortgage space, the non-QM space, we actually watched that space collapse overnight. That was the biggest casualty of April of 2020, was the non-QM space. So we saw a ton of panic exploration. It wasn't panic selling, it was panic exploring, right? So you had just every call was a hard money lender or a non-QM lender looking to get 103 cents on the dollar for the product like other companies were doing, but that was all paused. Now that kind of worked itself out since 2020. So we're not seeing a ton of QM stuff, although that market has changed quite a bit. We've seen, again, a balancing of the short-term loan space, but not to get too jumbled up.
What's the difference of the short-term loan space to like a hard money lender? Just what's the difference of the two?
So there's not much of a difference, right? So the hard money lender is going to be an equity-based loan where it's not necessarily, they're basing it off of equity. It's typically, when we say hard money, I interchange those, and maybe not correctly, so maybe some of your audience will fact check me on this, but I interchange these with fix and flip short-term bridge loans. It's the structure: interest only, low double-digit teens, 11, 10, 12% interest over the course of 12 to 36 months, 60% LTV, 65% LTV, typically on a residential property that's in the process of being renovated or repositioned, and then there's some sort of exit strategy to take out that short-term loan with long-term financing. So that can be used in the commercial space, that can be used in the business loan space where they're restructuring a business and they pledge collateral to restructure the business and then have SBA take it out. So there's different forms of this type of short term. And then of course, bridge loan financing. We need a bridge for the next 6 months. Now that stuff is attractive for sure. And there's definitely an investment strategy for that. But the way that we were developed was not necessarily a short term lender. If we're going to maneuver and park money, it takes a lot of effort, time, and diligence to move money from one asset to the other. We're not a trader. We're a set it and forget it investor in the most part. So we're not going to be hopping in and out of positions like a stock trader, 6 months here in this loan, 5 months here in this loan, although we will for a higher yield. So if we're going to be moving money around, it costs dollars to move money around. It also costs manpower, admin power, especially in an ever-changing market where the ground is shifting beneath our feet ever so quickly, because every time Jerome Powell goes on the news every 28 days, there's a 25 basis point or more rate hike, and rightfully so. I get it. They're trying to tamp demand. I mean, there's other ways to do it, I think, but I guess that's the way they're choosing to do it. And, that's what I see. On the flip side of that, you also have the commercial, right? So the commercial space, what we're seeing a ton of right now. And again, I know the owner carry stuff. I'm going to just pause and just take a couple steps back. The owner carry stuff is always there. We're seeing a ton of mom and pop lenders approach us, and they're reading the headlines. They're starting to get a little nervous. They're thinking about moving to Florida or moving to Belize or wherever they want to move, and they just want to cash out. And some of them are going through the 10 stages of grief because the mortgage loan isn't worth what they thought it was, and others are pleasantly surprised. So it really depends. That market is ever present, and it's there, and it's just as active as the institutional side. So just want to get that out of the way. So there's tons of opportunity in the seller finance space, as long as you know how to capture those leads and do it in a market effective way where you're not spending $1,500 per cost for acquisition on a lead, which some people do, which is very, very expensive. So on the flip side, whether it be commercial private loans or commercial institutional loans, we are seeing a ton of living assist facilities, mental care facilities. So there was a huge push when COVID happened. Every single bank wanted to get into this space, COVID, the new medical office space, the new, we saw a ton of banks get into it. And now we're seeing the same ton of banks get out of it because they realize that there's significant reality of, the reality is hitting them significantly on the risk factors that they would have never imagined, like meds going missing from staff, or staff making mistakes on med dosages, creating lawsuits with family members, like big challenges that happen. And that's just the most extreme. Of course, there's others like, hey, we just want to diversify out of this asset type because it's no longer aligned with our investment strategy as an institution. And, we hear that a lot as well, but that's one asset. And then others are, again, churches. We see a ton of those. We see a ton of, new. So the other one is construction. So commercial assets in the process of constructing 320 townhomes in North Texas, in South Florida, a lot of Texas and Florida on that stuff, some Georgia. There's one in Ohio that we're looking at. Some of them have certificate of occupancies already. Others are not even close to that. And a lot of these lenders are going through, again, the 10 stages of grief, understanding that they're trying to pull the ejection handle at an inopportune time where they're just over a body of water and there's no land beneath them to land on safely. So, we provide loan sale advisory. We're not, I would say that we customize loan sale advisory strategies for institutions that are looking to exit. Hey, we need good off ramps, we need good on ramps in some cases for this type of loan product. So we'll consult on that kind of stuff. We also are seeing, we'll provide that kind of strategy to private lenders for those who want to do a deep dive into strategic off-ramping, how to pull the ejection handle and have a safe landing and not crash land, and at a 40, 50, 60% discount on the note. And then we have other assets, and then I'll pause here, but we have other assets that we're transacting on where it's just vanilla, owner occupied, single family, jumbo, performing, desirable locations like Austin, Dallas, parts of Miami, parts of Orlando, very, very up the middle, large portfolios, almost $1 billion transacted. Almost $1 billion on my desk currently
of portfolios. So not just like one-off deals, but portfolios of.
So right. So we currently have about almost $1.1 billion in non-performing commercial and performing residential from 3 different lenders at this point in front of us right now. So that gives you guys an understanding of the veracity of what we're seeing these new deals, especially since Q3, the end of Q3, Q4 of last year, and Q1 of this year have been a massive growth spurt in our staffing as well as our footprint because of this, and our success in transacting on these assets.
And so I'm assuming, just speaking to, the non-performing loans, there's going to be a lot more due diligence that's going to take place behind the scenes, because ultimately the objective, I'm assuming, and correct me if I'm wrong, would be to get those notes reperforming, restructure them, and ultimately get them paying again in one way or another. Is that correct?
That's partially correct. So
Okay.
there's different strategies, as they say, different strokes for different folks. And that's really, so there's some strategies where we go in and we're like, okay, this loan, this person is obviously not in, this borrower is obviously not interested in working the loan out. The lender has made multiple years of attempts to try to get this back on track. It's approaching the statute of limitations. They're not even occupying the property anymore. There's no workout here. It's a collateral play, right? So it's a foreclosure,
Yeah.
taking the collateral back, and then maybe fire selling the collateral. Maybe in some rural areas, we have to then seller finance the loan, seller finance it all over again. So we don't mind doing that as long as we own the property for the right amount. And we do target, and I can get into those target metrics, but we do target. I shouldn't say target, but we mathematically calculate what kind of strategic position we're going to take depending on the population, the geolocation, the jurisdiction, the economic landscape. So if you're transacting in a city under 5,000 in population, where the nearest seaside city is about 50 miles out, 50 minutes away, you're probably going to have to seller finance that. Because you only have about 5,000 people that you're going to sell that to, unless you fire sale it. So you got to get it at a fire sale in order to turn a profit. You also got to keep in mind the holding costs, attorney fees, what kind of real estate taxes, water, sewage, debt, all kinds of stuff that can come up. But to answer your question directly, you are correct. In about 70% of the transactions, we would go in with the intention of working the borrower out, because quite frankly, we get a lot of lenders who just say, I am finished, dealing with this borrower. And then we talk to the borrower and they go, all we want is a second chance to rewrite. I get paid on the 1st, not on the 25th. My payment's on the 25th. I just need them to rewrite the loan on the 1st. No problem. We come in, we solve the borrower's problems, we solve the seller's problems or the lender's problems, and we would gladly take those. And to be quite honest, those borrowers are best paying after that. And a lot of the times they just need a little empathy. Really, that's what they need. And we provide that because we build that into our approach. So there's many different approaches, different strategies.
And so, and real quick, I know we're running out of time here, but as far as valuation's concerned, let's stick with the non-performing loans, because non-performing loans, because there's many different facets of your business. So I want to just hone in on one right now. From a valuation standpoint, just and I know that it's probably ever evolving, it's fluid, given the economic landscape, but just generally speaking, what does that model look like? What type of discount do you typically need to be buying a non-performing loan, either individual note at or a portfolio?
It could be 100 cents on the dollar, believe it or not, on the high end, and 35, 25, 10 cents on the dollar on the low end. And I know that's not a great answer. There's a lot to unpack there, but I'll give you an example.
Yeah.
Right now, real world example, we're looking at a non-performing construction loan in the Seattle area, the greater Seattle area, whereby the borrower is currently missed their balloon payment and is 4 or 5 months out. It's just gone dark. No certificate of occupancy. It was a 12% coupon rate. It was a short-term 3-year loan with personal guarantees. So there's human beings with social security numbers that personally guaranteed the loan in the case of default. And the thing is that the default rate is 24%. So that's a big number. It's a big default rate. So 24% return. So the bank or the lender that we're working with is saying, we want par on this. You got to, it's not an 8% default rate. 8% is not really a great return on investment if you got all this risk. 24, some people may argue that 24 is not the best default rate. There's more risk involved. But this lender will find an outfit that would pay 100 cents on the dollar or very, very close to it, because that default rate, and they would need to have a clear exit for that property or to work it out with that borrower. They'd have to have the appetite to work it out, because we haven't talked to the borrower yet, but from what we understand, the borrower does want to work it out They just can't make that balloon right now. There's supply chain issues. There's capital issues, the economic landscape, the great exodus from the Pacific Northwest, from what I understand, in that section of the world. So this was supposed to be commercial property for 29 residential units, and it's just not going as planned when they put this in motion in 2019. So we are going to be bidding somewhere in that range on that asset. So that's the extreme high end. And the only reason we're doing that is because A, there's a decent default rate, and B, this is going to unlock more business for us with this lender. So they're giving us their toughest, the lenders, what they usually do is they give us the toughest product that here, if you can do this, then you earned our trust. So it's not an easy deal, and we'll make that happen to earn their trust and to open up the door for more business.
What does that due diligence process look like? I mean, are you able to actually have any conversations? Probably not with the borrower prior to actually submitting a bid.
Not on institutional, but on seller financed, yes, it is possible. Seller finance for sure. The seller finance side is more personable. So with the institutional side, it's typically no. And if it's seller financed and it's a consumer loan, we would adhere to the consumer loan protection laws of that state. So we would make sure that it's all compliant. We can kind of go into that. But most seller finance, non-performing on commercial, that kind of stuff, we can request to speak to the borrower. And we usually open that conversation by saying, hey, Mr. Borrower, Mrs. Borrower, we are thinking about taking over this loan. We want to work with you. What's your issues? Talk to us. And they usually just kind of open up like a lotus flower. And we usually get a lot of good information that way, and we create a lot of good solutions that way. On the institutional side, you don't get any such courtesy. The only thing that you can request is the pay history. So you're building a story through the data. And most would say that could be the case. You can do that across the seller finance side or the institutional. Seller finance records are not as robust as institutional banks. You'd be surprised how non-robust the banks keep their records, but for the most part, they're better than private loan holders. So we would look at loan servicing records to see how the payments were made, when the payments were made, and if the loan servicer has comments. The borrower, I spoke to the borrower today. They said they were going to make a payment on the 15th, and the payment never came in. Tried calling the borrower again. He didn't answer. The borrower cursed me out and hung up on me. We would get the comments, we would get the records, and that would give us an understanding of who we were dealing with.
Okay. No, fantastic. Now that's all great. And again, just want to be respectful of your time here and appreciate all the valuable insights that you've shared with us today. And so I would say in parting, I know there's a lot of ground that we haven't covered. I mean, we could probably have multiple shows on the topic of your business and the many different, facets of your business. But with all that being said, any final thoughts, just words of wisdom that you would like to share before we wrap it up for the day?
I would, and I would like to say to your audience and whoever's listening that there's a tremendous opportunity on our doorstep right now. We're in the midst of it. In certain jurisdictions, and when I say jurisdictions, I mean geolocations, cities, states. Some are more opportunistic than others, but you want to focus on the properties that have been sitting on the market for many, many months. If you're looking to do property acquisitions, I know we're talking about notes, but I can tell you through property acquisitions, you want to find out who's selling these properties, why they're not selling these properties. Is it a price issue? Is it, there's some people that are just holding off and waiting for their price. And those are the perfect folks to utilize property acquisitions through seller financing. Mm-hmm. So you actually become the borrower. You circumvent the banking process where you don't have to be put under a microscope and provide W-2s and 1099s. All you can negotiate your down payment with the seller. Sometimes they just want their price. Give them their price. As long as they give you terms in exchange, you can walk away with some sweetheart deals that may be not reflective on the credit report, So I'm not suggesting that that's going to happen like that every single time, but there is a ton of opportunity out there. Even if you slightly overpay for the property, assuming it's a longer hold, that would be okay as long as they provide you with terms. That's one thing. And then the other thing I would say is that there's a ton of opportunities in the note space. There's a lot of burnt out landlords that are saying, you know what, I'm tired of getting into fixing toilets and air conditions and, dealing with tenants. And it's been great and it's been fantastic. But I just want to worry about, collecting the check. And that's what the mortgage, the performing mortgage note space is. We call it mailbox money, where the only three things you need to worry about are the taxes paid, is the insurance paid, are the payments on time. And that portfolio can be managed from Thailand, it can be managed from Florida, it can be managed from Kentucky, it can be managed from the UK. It's a very mobile type of business strategy. So I highly recommend those that are thinking about getting into it, that have money or want to diversify out of real estate into notes. Feel free to reach out to us. We would be more than happy to speak to you about that.
No, I love that, every bit of that. And just really speaking to the price or terms, the first piece of advice you provided there. And guys, we literally just bought a $10 million mobile home park in that exact same scenario at the end of last year, 2022, and been one that we've been working on for many years. And he was just stuck on a price, and the price was not really indicative of the market per se. It did appraise slightly higher than what we paid for it, but based on where debt terms were at that point in time, it wouldn't have made economic sense. But we got him to carry financing, probably the most attractive owner financing note I've ever negotiated in my life. And the terms absolutely make sense. I think 4% interest rate, 5 years interest only, 30-year amortization, and a 15-year balloon. So nothing like that existed in December of 2022. Not even close.
Not even close.
So,
Not
even close.
I saw your previous shows. I know we're going to cut short here, but mobile home parks is a love for us as well. We didn't touch on that at all. I saw your previous show with your previous guest, the young lady who was a mobile home park investor as well, some time back. We love mobile home parks. We actually provide lending on mobile home parks, mobile home park conversion to tiny home villages. And we also provide something called hypothecation lending, where mortgage lenders can, instead of selling the loan at a discount, they can pledge their performing mortgage loans as collateral and borrow against them. So that's a whole other lending product that we kind of deal in, which is very off the beaten path.
Well, Abby, this has been a lot of fun. I appreciate you coming on today and sharing all your insights. And for those that want to learn more about you and your firm and the different services that you provide, where's the best place to find you?
The best and quickest place to find us is at our company website, which is Amerinote Xchange.com. The word exchange is only spelled with an X. Again, that is Amerinote Xchange.com. Of course, if you just throw Amerinote into a Google search, you'll quickly find us. Or, of course, if you just throw my first name, Abby, and the keyword terms note buyer or mortgage note buyer, will quickly show up. We are front and center in this space, and we love speaking to anyone who's willing to listen.
All righty. Thanks for joining me, my friend. It's been a lot of fun having you.
Thank you, Kevin.
All righty, guys. That's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.